Financial planners often categorize the individual defined contribution pension, or iDeCo, alongside mutual funds or stocks. Evaluating iDeCo as an asset is a category error. iDeCo does not generate a yield on its own. It is a strictly defined tax-advantaged account structure. It is the container, not the contents. In the U.S., a 401k or IRA is an empty legal wrapper recognized by the IRS. iDeCo functions on the exact same mechanics in Japan. You do not invest in an iDeCo account. You invest through the iDeCo structure in an underlying financial product. When an investor asks if iDeCo is safe or risky, they are evaluating the container instead of the assets inside it. This leads to inaccurate risk modeling and miscalculated return projections. To accurately model a Japanese retirement strategy, we first need to define the strict legal and mechanical boundaries of this wrapper. Next, we have to examine the specific categories of financial instruments the government permits inside the structure. Finally, we will break down the mathematics of its three-layer tax deferral system to see exactly how it optimizes capital growth. Designing a highly optimized Japanese pension portfolio requires us to mentally and mathematically separate the tax wrapper from the underlying assets it holds. This diagram shows the baseline structure of an iDeCo account. Before any investments are chosen, it is simply a highly regulated, empty vault waiting for capital. The primary mechanism required to utilize this structure is a continuous stream of fixed monthly contributions. The government mandates a strict financial floor to keep the account active. You must contribute a minimum of 5,000 yen every month. Once that capital clears the threshold, the structure is entirely self-directed. The account holder holds sole authority over how that incoming capital is allocated. However, the Japanese government does not grant tax advantages for free. In exchange for the structural benefits, the investor must accept severe liquidity constraints. The moment capital enters the iDeCo wrapper, it is subjected to a strict lock-in period. Access to the principal and any generated returns is entirely restricted. This capital cannot be withdrawn until the account holder reaches exactly 60 years of age. While the tax code does contain exceptions for severe disability or death, they are highly rigid. For standard financial planning purposes, early withdrawal is mathematically and practically impossible. The iDeCo wrapper demands an absolute sacrifice of liquidity. Long-term capital commitment is the non-negotiable cost of entry for these structural tax advantages. With the exterior boundaries and liquidity constraints defined, we look at how to populate the empty space inside the container. Investors do not have open market access within iDeCo. Instead, financial institutions provide a strictly curated, limited universe of allowable products. The first and most common allowable asset class is investment trusts, which operate identically to mutual funds. Within this category, providers offer a spectrum of actively and passively managed funds. This includes broad exposure to domestic and international equities, fixed income bonds, and balanced target date funds. The second permitted class consists of principal-protected deposit products. These function like fixed-rate savings accounts or certificates of deposit. Finally, specific providers offer a third category of insurance-linked investment products designed for conservative capital preservation. Notice how market data interacts with the structure. Volatility and market performance apply strictly to these specific internal nodes. The outer iDeCo wrapper remains completely static, indifferent to market movements. The ultimate risk profile and yield of an iDeCo portfolio are dictated entirely by the underlying instruments chosen. A poorly allocated iDeCo account will lose money, regardless of its structural tax advantages. We can now map the exact flow of funds to demonstrate the core value proposition of iDeCo, a three-layer tax mitigation system that generates structural alpha. Structural alpha refers to outperformance achieved purely through tax efficiency and account mechanics, rather than market selection. This flowchart tracks a single unit of capital. Before this capital even enters the wrapper, we encounter Layer 1, the contribution deduction. Every yen contributed to this structure is fully deductible from the investor's taxable income for that specific tax year. This creates an immediate, guaranteed reduction in the current year's income tax burden. This tax savings is the portfolio's first actual point of yield. Once the capital is locked inside the account, we reach Layer 2, zero-drag internal compounding. Any dividends, interest, or capital gains generated by the internal assets are completely shielded from taxation while they remain in the account. A standard brokerage account suffers from constant tax friction, losing roughly 20% of every realized gain. The iDeCo structure simply repels this friction. Over a multi-decade timeline, reinvesting gross returns instead of net returns creates a massive mathematical divergence in total capital accumulation. Layer 3 occurs decades later, at the exact moment of distribution. The mechanical trigger at age 60 finally releases the lock, allowing the multiplied capital to exit the structure. When these distributions exit, they do not face standard income tax rates. Instead, they receive highly specialized statutory tax deductions upon withdrawal. Depending on how the individual structures their exit, either as a lump sum or an annuity, the effective tax rate is drastically reduced compared to standard income or capital gains taxes. The wrapper mathematically engineers a preferential financial outcome. It defends the capital at entry, protects it during growth, and minimizes friction at exit. This waterfall chart compares two capital pipelines. Pipeline A, standard investing, constantly leaks taxes during the contribution, growth, and distribution phases, diminishing final output. Pipeline B, the protected iDeCo system, experiences zero leakage at entry and growth, dictating a substantially larger final pile of capital. For CPA candidates and professional tax planners, this exact mechanical system goes by a precise term, a tax deferral strategy. The macroeconomic logic driving this is deliberate. The Japanese government is purposefully forfeiting immediate tax revenue today to guarantee the long-term retirement security of its citizens tomorrow. To achieve that policy goal, the government has to overcome the human preference for immediate liquidity. They structurally incentivize the investor with the undeniable math of upfront income deductions and decades of tax-free growth. A professional advisor must analyze client portfolios through this precise structural lens, ensuring the correct asset classes are placed inside the most efficient legal containers. True mastery of the Japanese pension landscape requires looking past the asset itself. You must legally and mathematically separate the market yield on an investment from the structural alpha generated by its wrapper.